My name is Matt Ramage. I'm with the Oregon Division of Financial Regulation, and I'm going to talk about insurance and all those fun things. And if you have questions, you can throw them at me via the chat, and I will try and answer them to the best of my ability. My experience in this area is that I used to be an insurance agent for just shy of 3 years. Prior to that, I worked in private industry, specifically consumer electronics, for 27 years. So that's kind of my gig. DFR's primary mission is to provide Oregonians, kind of cover. We want to make sure people have information to make good decisions because everybody's situation is different. We're not trying to tell people what to do. We're not going to force people in any one direction, but we do want to make sure that the financial services that Oregonians engage with, that you're being treated fairly, and that you have good resource information and that they're regulated properly. So that's really what we're trying to do and make sure that folks are aware of that. And in many cases, unless you have worked in one of these financial industries that we regulate, you probably don't have any idea who DFR is. So I'll go into that a bit. We're part of the Department of Consumer and Business Services, or DCBS. There's 5 divisions there. Building codes helps make sure that the standards with which buildings are constructed are maintained. There's OSHA for worker safety, our division, DFR, and then there's the 2 sister divisions for workers' comp, and then the Independent Workers' Compensation Board. All kinds of fun stuff, all under the umbrella of DCBS. But DFR oversees the financial institutions that Oregonians all interact with. At the top of that list is insurance, and it's personal lines insurance, which is automobile insurance, home and health insurance, life insurance, umbrella insurance, commercial. And really, that's the biggest chunk. Probably about 80% of it is insurance related. Also, mortgage lending, investments through annuities and securities. We do a lot of work with a student loan program, through a student loan ombuds program, because that's a pretty jacked up situation right now. If anybody's watched the news, don't watch it too long, it'll freak you out. State chartered banks and credit unions, we regulate that area. Anything to do with personal finance and money transmitting, pawn shops, any of that kind of stuff, scams, we help people a lot try and navigate through any of those horrible situations, get lots of phone calls there, consumer finance, that sort of thing. The list goes on and on and on, and things just keep getting added up. But fundamentally, really anything to do with financial transactions, we're there to help people sort of navigate how to figure it out. And if we can't directly help them, we're going to try and get them to the right resource. Sometimes it might be the Department of Justice, maybe it might be FBI if it's a scam being operated outside of the United States. But we're really trying to help people find a resolution to their problem. Within DFR, we have a consumer assistance or advocacy team. These are awesome folks that help individuals answer simple questions and sometimes navigate some real cumbersome problems. At the core, you think about insurance. I don't know if anybody's read through an insurance contract in length, but they're pretty difficult. I was an agent myself, like I said, and you read through, you're like going, I don't really know what's covered. As a layperson and you're reading through it, it's really difficult. And so sometimes we just have people call and say, I need to know if this is covered. I had a raccoon get in my crawl space and rip all the insulation out. Is this going to be covered? And the advocates can help them figure that one out. Or they can go through things like, hey, I've filed a claim, I've worked with my carrier, and they're just stalling. They're not responding to me. They can reach out on behalf of policyholders and say, hey, we're calling on behalf of Matt, and it seems like you're not really responding. What's going on? Sometimes just that phone call kind of gets things moving along. Other times they may say, hey, it seems like you might need to file a complaint. We're not going to file a complaint on behalf of people. They're not attorneys. They're not going to represent anybody in court, but they are going to identify when it seems like agents or companies are not operating within the statutes and push them to file a complaint. Once a complaint's filed, it goes to investigation. And if the investigation reveals things are not going as they should, there could be enforcement. Enforcement might entail fines or revocation of licenses and all sorts of fun stuff. The reality is that it's all there to help protect Oregonians. In 2024, we helped almost 18,000 people, resolved over 5,400 complaints, but through that process returned over $8.9 million back to Oregonians. And that was because of either premiums that were paid that were too high or claims that should have been paid to people. Now, again, I want to reiterate that doesn't mean every claim that was denied is going to get paid just because you called and asked the advocates to assist. But hey, if it was denied and it should have been paid, it doesn't hurt to call and say, hey, I need some help. So give them a shot. We offer all sorts of resources. I want to make sure you check that out. You can go to the website, dfr.oregon.gov, but that's not what we're talking about today. Really, it's about insurance. And here in Oregon, I've been here my whole life, a couple of years. And as a coastal state with mountainous regions and high desert and all sorts of great geography and weather, we're exposed to a lot of risk. And insurance is about managing and mitigating risk. And there's really only one way to eliminate risk, and that's not to have it. Like you could say, well, I'm not going to drive. You don't have the risk of having an automobile accident. But you don't really have the opportunity to say, hey, I'm not going to have the risk of a weather-related incident at my home, because you can't control whether the wind is going to blow or whether it's going to rain. So, here we have, wind-related problems. You have flood. Wildfire is an obvious huge risk here in Oregon, and one I will talk a lot about because it impacts the accessibility and affordability of insurance in Oregon tremendously. And earthquake. Flood is one that I think people lose sight of a lot. And that is that you don't have to be near a river or a lake or the ocean to be worried about flood. If you live anywhere in the state of Oregon, or anywhere for that matter, and the water were to rise or it rains a lot and that water flows over soil and it comes into your home, that's flood, and your homeowner's insurance is not going to cover it. And so understanding what is covered on your insurance policy and what is not covered on your insurance policy is super, super important. So this is part of this presentation, is making sure that you as an individual understands what's covered under insurance, and when you're representing properties, understanding what the risk is. It's extremely important when you look at properties that have slopes near them, because that slope represents the potential for runoff to create flood damage or mudslide damage after heavy rains. And it's pretty important to think about, should there be flood insurance in this home as well? And when you couple the potential for wildfire, which clears ground cover away, and then heavy rains, you could have a pretty devastating flood impact. So something to think about. And then the other piece on this one is earthquake, which is absolutely not covered by standard homeowner insurance. You can get coverage for it, but again, not something you would have on a standard policy. And if you believe the science, there's going to be a big one that hits, 7.0 or higher in the next 15, 20 years. And if that occurs, we're talking massive damage to homes that were built prior to earthquake standards, and significant damage potentially to homes even that were with earthquake standards. So again, if you have the right insurance, you can navigate through this and not be devastated financially, but you're still going to have impact. So stuff to think about. This chart is one that I've used a lot when I talk to people about why has insurance got so expensive. Prior to 2020, when you go back, those previous 40 years, insurance payouts in the state of Oregon were pretty minimal. Yes, there was damage. There were fires. There were windstorms. But there was nothing so extreme that it created major blips. It wasn't until the 2020s when we had these major events. Previously, a couple $100 million in insurance money was nothing. To me, that's like a massive amount of money. But in insurance, for total payouts in Oregon alone, a couple $100 million is nothing. But when we got to 2020 and those Labor Day fires, from 2020 to 2024, the insurance industry paid out $3 billion in wildfire losses alone. When you layer in wind and other weather-related catastrophe losses, we're now over $4 billion in payouts in Oregon alone, all by itself. That's the crux of what has caused the insurance losses and increases in Oregon. And it wasn't until then that things started to go crazy. Coincidentally, in 2020, that's also when the wildfire hazard map also came out. And it created a lot of angst because a lot of people said, oh, no, that wildfire hazard map is what created my insurance rate spike. Had nothing to do with it. Map didn't create the fires. Fires were caused by all sorts of other things. A lot of them human caused, a lot of them lightning caused. You can debate that all you want. But the existence of the wildfire hazard map was coincidental. And unfortunately, it's the losses, and the losses create the rate increases, and we're all, as policyholders, sharing that impact as we go forward. And we'll talk about how that applies to things a little bit later here. In the past year, there's been a couple of legislative updates that have occurred. Senate Bill 83 was in response to Senate Bill 82, which created the wildfire hazard map and some building codes. So 83 repealed it because a lot of people oppose the hazard map and the building codes, which is fine. That's what we get to do. People get to make decisions as a constituency. So the map was repealed. The impact is it's gone, and the building codes associated with it are gone. From an insurance standpoint, it does not have really any impact at the moment because the map was never used for insurance, never could be used, and frankly never was used because insurance companies have an arsenal of other tools that they use to do rating of insurance policies. The building codes are still in existence, but they're not used at the state level. They're available for local either city or counties to apply if they wish, and some have done so. Sisters is an example. They've applied and passed pretty stringent building codes. I think Ashland has done the same, and a few other are in the process because they want to establish defensible space to protect their towns. And arguably that may make sense. And so as time goes on, that may continue. Senate Bill 85 was passed, and that directs DCBS, our parent agency, Oregon State Fire Marshal, Oregon Department of Forestry, and the insurance industry to come together to talk about what is a good way to develop community-based wildfire mitigation strategy, standards, and a certification process. And why this is so important is that it makes them come together and sit to develop a plan, as opposed to a standard being set and shoved down someone's throat. Because I think, as anybody would likely agree, when a standard is created and forced on any one group, there's a lot of pushback. But when people develop it together, it's more often acceptable. The benefit of this, hopefully, is that when this hopefully goes through, property owners can then get their properties certified, and then with that certification then can get access to insurance. It may still be pretty expensive. It might cost you a kidney to get your property insured if you're in a rural area in a higher risk zone, because you've got a lot of fuel around you, but you can still get insurance, because that's the big issue. Our primary issue with insurance right now is accessibility and affordability. What we want to chip off is, can we still make sure people can get insurance, and then try and address as best we can how can we make sure that it remains affordable. So the community-based standards of defensible space and home hardening, those sort of things that the insurance industry is going to recognize, will start to address that accessibility and affordability issue. The other things that were addressed, there's lots of legislation that was done, but 3940 helped move some money around to make sure wildfire Funds were there to fight fires. Luckily, this season has been a lot less severe than it was projected. Last year, 1.9 million acres burned in Oregon, and it was thought to be somewhere on par with that this year. We've only seen about 350,000, which is a godsend. Actually, it's pretty amazing that that's only that little has actually burned, and I hope that continues to be the case. And then the other House bill with respect to insurance that passed was 2563, which requires insurance companies to be so much more clear and reasonable in their written explanations of premium increases. Because what they've been doing or tried to do is pass through rate increases with no explanation, and it's been pretty unfair. So you'd get a 20 or 30 or 40% rate increase with absolutely zero explanation or some hyper technical explanation, and it just is just absurd. Now they're required to give a very clear explanation as to what's going on, and not bury that. And so that's a little more helpful for people to understand. So anyway, with respect to properties, really important for homeowners and for people that are representing properties is to take a hard look at that property to assess the risks that are there. And so this is something that, when I go and talk to people in communities, and I do it often with fire representatives as well, they'll look at it from kind of a different perspective. Insurance looks at it from the risk of what's the loss risk. And they often do it from aerial imagery. They look at it from the standpoint of, are there trees right next to the property? Are there branches over the roof? What's the access to the property? How far is it from local fire stations and those sort of things? But you would want to look at it from the same perspective, because underwriters are going to have a massive problem when you've got huge trees that are over the top of the roof line. And frankly, they're not going to want to probably write policies if that's the case. So a big problem there. Defensible space, which I'm sure you're probably all heard about, is a concern. And having that immediate space around the home of at least that first 5 feet, not having organic material is very important. And having it clear of things that are combustible. So again, when you look at new properties, this is something that's becoming more and more prevalent with a lot of underwriting and insurance companies. And I believe that as that Senate Bill 85 becomes ratified, which likely won't be until 2027, that'll likely become part of that certification process, where it'll be more mandated that you got to have no bark dust up against your foundation, and no shrubs underneath your windows right there against the house. So pretty important stuff to think about, and about addressing home hardening and those sort of things. So real good stuff to think about. This is an image that came from the Insurance Institute of Building and Home Safety, the IIBHS. And what it really illustrates is the danger that comes from the types of building materials that are often used in traditional homes versus a home hardened structure side by side. Traditional home with wood shake siding and bark dust around the foundation on the left versus a hardy plank styled home with rock around the foundation. And it's kind of hard to see, but what's flying at the home is embers from a wildfire. And this is this is actually about a 12 or 14-minute video that IBHS did on this, and they're simulating a wildfire, and it's amazing at how quick the regular wood structure with bark dust catches on fire and is engulfed in flames, and the home hardened structure survives. And it's relatively simple to do some of these things to get bark dust. Bark dust it's kind of like natural gasoline. You don't want to have it next to your house if you want to keep your house from burning down. I will also say that as an insurance agent, it is extremely hard to get homes that have cedar shake or shake siding insured these days, and absolutely impossible to get a home with shake on the roof insured. So Don't even try. It's not going to happen. Stuff to think about. When evaluating insurance needs, really it's important to understand the types of coverages that are available and the need to do regular review. So for you, for yourselves, for your clients, and to make sure that that's occurring at least annually when those renewal statements are coming out, or if changes are made. So, and changes meaning if your risk profile switches, maybe you have become a couple, maybe you are separating, maybe your kids are now drivers, maybe you've made a major update to your home. All of those things change the risk profile of a property or your risk because of your family structure. And your insurance company doesn't necessarily know, and your policy doesn't change. But if you have a loss and the policy doesn't change, you might have a significant financial delta that needs to be addressed. Because what you don't want to have happen is you have, let's say, a catastrophic loss and you're now $100,000 underinsured. Insurance company doesn't care. They're not going to give you more money because you have more loss. They're only going to pay what the policy limit is. So it's up to you to make sure you make that adjustment. Make adjustments as you need. Protect yourself. And sometimes those adjustments are a downward adjustment as well. But at any rate, you want to make sure that you adjust to protect yourself appropriately. Oregon is what's called a standard fire state. And what that means is that for a standard issued policy for a standard insurers are the big national companies like State Farms and Safeco's and all the other big ones you'd recognize. Those are also the ones that we as the state entity license and regulate. Standard companies have perils that are going to be on their typical homeowners policies. Fire is always the first listed peril. Fire is covered. I don't care what kind of fire it is. Chimney fire, electrical fire, kitchen fire, all of them. There's only one fire that's not covered, and that's arson. So if you light your house on fire, they're not going to cover that. And it's pretty much a standard language in any insurance policy. Intentional acts are not covered. So if you light your house on fire, or if you take a hammer to your car and knock dents in it, they're not going to cover that either. But in a standard policy, typical things that are covered: fire, weight of snow and ice that might accumulate on the roof, wind and hail. So if they were to have a big windstorm and it blew shutters off or blew shingles off your roof, that would be covered. Power surges, falling objects like a tree, or if a plane fell out of the sky and knocked out your house. Seems kind of an obscure example, but that would be covered. Theft and vandalism. A broad coverage homeowners policy generally has 14 perils listed. That would be kind of the all-inclusive, what's called an HO3, a broad coverage policy. But it's important that you look at a policy and really read it, because they're not all exactly the same. And so you want to make sure you look at what's covered and what's excluded. And then you also want to look at is what not covered is very, very important. And the first two listed there, earthquake and flood, I touched on that previously. Those are big things that are not covered on a homeowner's policy. You can get coverage for both of those. And some standard policies will endorse earthquake and or flood. It used to be more common that you could get that coverage with your homeowners as an endorsement. More and more, they don't do that. They don't like to add that risk to a homeowner's policy. There's a few. I mean, there's a handful that will do it now. And there's a few policies that are probably out there. If you have your own personal insurance and maybe you've had it for 10 or 15 years, you may actually have earthquake and or flood on your personal homeowner's policy as an endorsement. But it's pretty uncommon right now. I had personal experience this spring. I was down in Douglas County responding to the flood experience where people experienced down there when that atmospheric river came through. And it's pretty sad because folks came through and they're like, well, I had flood damage, but I have homeowners insurance, so I'm in good shape. And it's like, no, you don't. You're not covered. I'm like, well, what do I do? I'm like, well, it's on you. You have no coverage at all. A few actually did have flood insurance, and they said, well, I have flood insurance, but it occurred in my basement. I'm like, well, that's unfortunate because had you read your coverage, you'd realize that flood insurance doesn't cover anything below grade for living space. And I bring this up because, again, it's really important to read your coverage limitations, especially things like flood or earthquake. I don't care whose flood policy is issued, whether it's the National Flood Insurance Policy or NFIP, which is federally backed, or a private flood insurance policy. And there's some really good programs through private flood insurance companies. Typically, they're going to have some pretty stringent limitations. And the big one is they don't like to cover anything below grade because water naturally collects in the lower sections of a home. So if you have upgraded a basement, you put in hardwood floors down there, you have living space down there, they're not going to cover it, which is pretty bad. And you're going to have a total loss down there. The only thing that will be covered generally on a flood policy in the lower grades is going to be systems like heating systems that are installed and that sort of stuff. So you don't want to put the antique piano and your really expensive stuff in the basement on a flood policy. The other thing about flood is NFIP, which is again the National Flood Insurance Policy that's federally backed, is it is an essential policy, meaning it's pretty bare bones. Its maximum coverage is $250,000, and for just the dwelling alone, the structure, and $100,000 for personal property, and it's just the structure. Nothing else on the property. So if you had a shed or a deck or a barn, nothing. It's not covering any of that stuff. And if your home is worth $800,000 and you have flood damage, doesn't matter. Your maximum amount of coverage you're going to get on the NFIP flood policy is $250,000. So you really need to be mindful if you're looking at a property that needs flood insurance, that NFIP policy is going to max out at $250,000. And lenders are going to require flood insurance, but that's the max coverage they're going to get. Private insurance will allow you to go higher, but it can be extremely expensive and can oftentimes price people out of the market, or they may say, I can't afford it. So that's the issue. Let me check these questions real quick. Alrighty. So you don't have to be in a floodplain to get flood insurance. And so what I would say is with respect to getting flood insurance, you talk to your agent. There's two ways. Like I said, you can go to the federal one if you're not in a floodplain, which means you're in a much lower risk flood area. You can go to floodsmart.gov, and that would be probably the best way to get a quote. And you can actually probably get a quote yourself right online that way. I'll put that in the chat. There you go. And check it out, or talk to your agent, and they can get you a quote. But you shouldn't have any problems getting a quote from floodsmart.gov, although the federal websites are a little wonky right now. They say they're understaffed and that sort of thing. Okay. The other things about things that are not typically covered is that with flood in particular, flood and tsunamis are linked together. It's a water-based risk. So if you have a coastline-based property, you might need to get flood insurance because of tsunami. Landslide is a whole different beast, and that would be a policy you would want to get called a difference in condition policy, and it's a pretty unique one. And talk to an agent about getting that one. So if you got like a big hillside with a cliff behind you, and the risk is you're thinking that maybe that thing's going to slough off and crush a home, a big chunk of land might fall. That's a landslide. You want to get that one. Sinkholes are not really a big deal around here, but again, that's something that's unique you want to get for. And again, what's never covered on a homeowner's policy is wear and tear. We as property owners are responsible for maintaining our properties. We got to keep the paint up, make sure the windows aren't broken, and we don't get to say, "Oh, my roof is 30 years old. I'm going to make an insurance claim." Yeah, that's us as homeowners. We got to do that stuff. Okay, let's see. I'm assuming that presentation's still showing. Yep, looks like it is. The policy itself, the declaration page, I think most people have looked at them and see them, but it's really important to understand that when you have a policy issued, that they're broken up into coverage types: coverage A, B, C, D. Coverage A is for the dwelling, and what an insurance policy, and when it's issued, it's for the replacement cost of the dwelling itself. You're not insuring the loan. You're not insuring what it's valued at on Redfin or Zillow or what it's sold for. And I've had this kind of interaction with agents a lot. It's like, oh, no, it sold for 1.2 million. That's what you insured for. No, what it's insured for is what it's going to cost to replace it. And so it may be that the replacement cost is $800,000. That's what the limit should be on the policy, is the replacement cost. Maybe a little bit more, not the market value. It's what it's going to cost to replace the structure or structures on the property. And on the dwelling, you want to make sure that's the right value. And so they go through that pretty forensic discussion about how is it made, how many levels, what's the square footage, what are the finishes. You don't want to shortchange that. You want to make sure that there's all that detail is put into that conversation. And then the optional things like the extended replacement, it's a really good thing to consider because it gives you protection against fluctuation in cost. As an example, let's say the agreed upon replacement cost to rebuild that home is $500,000, and that's what the policy is issued at. But a wildfire comes in and takes out that home and 10 others in a neighborhood. When that happens, it's pretty typical that the cost of materials and labor and everything else starts to rise. And that surge in cost all of a sudden says, well, it doesn't cost me $500,000 to replace that home now. It might cost $600,000. Well, the insurance policy doesn't automatically float. It says, well, I'm only going to pay up to my limit, and you're now $100,000 short. If you had extended replacement cost, it would automatically adjust. And how it's usually written is as a percentage, 25%, maybe 50%, or 100%. At 25%, you're going to have access up to, in this case, an additional $125,000 of your original value, $500,000. But you're not paying for $125,000 of coverage. You're paying for the potential to maybe need $125,000. So it's really an expensive way to get some additional protection. And as an agent, I used to offer that and make sure people understood, you don't have to do this. It's some protection for you. The same thing applies to things like building code upgrade, because insurance is written as protection for as built. It's going to replace the structure as it was built, not to the new building standards. So if it was built in 1975, it's going to build it back to what it was built as, not to the new standard for electrical or the new standard for earthquake. It can, but those additional costs are going to be on you as the homeowner. So it's a good idea to consider with those building code upgrades as part of the insurance policy. Same for sewer and water upgrades and hidden water damage. So stuff to think about. Other structures as part of that policy, these are the things that are not attached to the home. Makes sense for things like a deck or a fence or a barn. But the garage that is not attached to your home, that is physically detached, not connected by a wall or the roof, that detached garage, it needs to have the right amount of coverage limit on detached structures or other structures. It might be labeled that way. That's the right amount. And some detached garages are pretty snazzy. So you want to make sure you got the right amount on the policy that's correct. Because if you've got a $200,000 detached garage structure that's a shop and a living space, but you've only got $20,000 of other structures, you've got a big gap. So you want to make sure. The approximate other that's like how long's a piece of string. I can't really tell you that. The thing about getting a quote is quoting is free. You ask your agent, what if I add additional cost here? What if I do a deductible increase here? There should be absolutely zero cost to you to say, do this, twist it this way, add this cost here. You should be able to ask your agent to cut you different quote levels, all sorts of different ways. But I can't tell you what it's going to be because I don't know. I mean, everybody's situation is a little bit different, and that's sorry I can't give you that exact answer. It shouldn't be massive though. All right. Contents coverage is your stuff. This is your shoes, your housewares, your furniture, your things, and it's usually set as a percentage of the dwelling limit as a starting point. So generally speaking, if the dwelling limit was at 500,000, it might start at 50% of that just to sort of preload the policy, but you can adjust it up or down from there. So let's say your contents coverage is at $250,000 to start. Okay, fine. But what's important is you've got limitations on certain categories of things within that policy. And if you're fine with that, that's great. But things that are limited are going to be jewelry, firearms, collectibles, fine arts, cash. And if you have things that are in those categories, and the limits are pretty low, $3,000 to $5,000 probably on most of those. Cash is even lower, maybe $500 or $1,000. So if you got a stack of $10,000 in your house and fire comes through, and what you're left with is ash, you're not getting $10,000 back. So you want to make darn sure that you either have the appropriate fire safe protections, or that you don't keep that in your home. Or if you've got jewelry, a 5-carat solitaire that's pristine, that's worth 60 grand or something, that you have the right endorsement on your policy for it to protect it, or that you're okay with the gap in insurance. But what you don't want to have is you have a loss and realize that you're only insured for $5,000. So make sure that you understand that there's going to be some pretty big gaps between those limitations in some categories of product on your policy. ALE, which is additional living expenses. It's also called loss of use. This is available to homeowners or renters. And what it does is it covers the cost if you can't be in your residence, if you have a peril that's like your house is on fire, or you've had water damage and you got to live somewhere else. It's really important benefit to people that a lot of people just aren't aware of. And it kicks in and has a cash value and also a time value. So at a minimum, you can tap into it for 12 months. Oftentimes it goes up to 24 months, depending on if it's a disaster. But your policy is going to show you, hey, do you have $20,000 of ALE, or you've got $120,000 of ALE, but it's going to cover living expenses. It's going to cover potentially transportation, maybe pet boarding expenses, all sorts of really important things. But you want to make sure it's the right amount of money that is appropriate for your needs, and make sure you look at that stuff. So, all right. Homeowner's policy versus a renter's policy. Big difference there is that you own or are in the process of buying a home, so you have ownership interest. You can insure the structures. So you're insuring the dwelling and the other structures on a homeowner's policy, and then you have personal property and liability and additional living expenses and other endorsements. You don't do that on a renter's policy. Your coverage starts at your personal property, liability, and the other endorsements. And you may have that requirement to have a policy with a renter's insurance from a landlord. You're absolutely going to be required to have homeowner's insurance if you have it financed by your mortgage company. From an inventory standpoint, it's an awesome idea to have some type of inventory in a homeowner's policy or a renter's policy. And there's a ton of different ways to do it. You can go old school. You can get a piece of paper and a pen or pencil out and start writing things down. That works. You can take your camera and take pictures. You can use a video or your phone. If you're going to do video, don't do it Blair Witch style and get all jerky. Do it really smooth and slowly through a room. And it would be really helpful for you in particular if you open cabinets and closets so you can see what's in those spaces. Because if you actually have a loss and you have to recreate what's in there, you're going to want to know what do you got. And for big items, probably you're going to know model numbers. That 75-inch flat screen. You want to know how expensive was that thing actually, so you can recreate that stuff. There is a bill that passed as of the 2020 fires that allows people to claim 70% of their personal property coverage with no inventory at all. You can just say, you know what, I don't want to put myself through it. I just give me 70% and I'm done. So if you had $300,000 of personal property coverage on your policy, you say, give me 210, I'll walk away. You could still come back and open that claim later with an inventory and say, no, I want to amend my claim and increase it up if you could prove you had more. But if you didn't want to go through the stress and hassle, you could just claim 70%. Because I'm sure it would be exceedingly painful to do. Okay. DFR's role in managing rates is one where we work with the insurance companies each year, because every year they have to file their rate revisions. It's when Oregon has a system that's called file and use. And the insurance carriers have to go through a really lengthy and detailed process of justifying any rate change. And I was going to say increase, but they're not going down. So it's an increase because right now rates are going up. And what they do is they look at what they've paid out in the prior period. They look at their policy holding position, and they have to forecast, do they believe that they're going to continue to see rate changes because they're paying out? And what do they have to do to protect their current policy holding position? And they file that with DFR. DFR then looks at it and says, okay, does it meet the standard? Are you saying your rate increase base is 20%, but you're going to go up 30? Well, that's excessive. Are you saying your rate increase is 20, but you're only going to go up 10? That's inadequate. That's a pretty easy math to do. The unfairly discriminatory one is a little more difficult because the standard is for like risks, they have to charge the same rate. And a lot of people would say, yeah, but I live in a neighborhood. We have the exact same home, the same square footage. My neighbor and I are the same age. We should pay the same rate. Yeah, but in underwriting, there's so many factors used. There's the replacement cost of the home. There's the location where it's at, distance it is from fire protection, the construction type, the home's age and condition. All those are factors. The roof age was a big one here. If a roof now was more than 15 years old, insurance companies have a huge problem, and in many cases are not issuing policies or doing non-renewals. But then you get into the personal factors, your credit score and your insurance score, which is how long have you had insurance with a particular company? How many claims have you had? And claims is getting real messy within the last 5 years. And not just the last 5 years at your residence, but let's say if you've moved. So if you've had a claim at your most recent residence, or if you go back to where you lived prior to that, and if you have, let's say, a vacation home, or if you have rental properties that are in your name, any claims there. If you're looking to purchase a home, any claim at the home you're looking to purchase, all of those claims are now subject to potential consideration for a new policy. That's all part of the claim history. So all those factors are being used under the water and in the statistical analysis by the insurance companies to consider rates. And so that unfair discriminatory piece is a lot harder to determine. It still doesn't mean that there are not unfair rates being issued, because I think there absolutely are at times. And we 100% would encourage people to please, when you feel like you're being taken advantage of or the rates are crazy, please call. Please report that and say, hey, something's crazy going on here, because we want to investigate. We want to find out when that's going wrong. If you get those renewals, you personally or your clients, first ask why, ask for it in writing. That's super important. Main reason one is you want to know what's going on. If you could get it mitigated, if it's something that's tangible, if you can fix the reason, if it's the roof, fix the roof. If you can fix the railing that's broken, you want to know why. You also want to know, because if you go shopping, it's going to come up again. Those things are not hidden. Insurance companies talk. Ask for discounts. Any discount you can get. Bundling actually is real. The more insurance lines you have with companies is going to benefit you. You can also ask for what's called an annual re-rate. So really, any policy issued after January of 2004 used a rating system. And when the policy was issued, they rated it, but they don't re-rate it each year. You can ask to be re-rated. If your score improves, it's going to help your premium. But if your score goes down, they can't apply it to an existing policy, which is great. So there's no harm in saying, hey, re-rate my policy. It's a no harm ask. And in many cases, it's going to help you. If you're shopping for a new policy with a new carrier, they're going to rate you, and your score is your score in the moment. So, but on a current policy, ask for a re-rate. Could help you a lot. Works on any personal lines policy, home or auto. Totally worth a shot. For coverage levels, I would 100% never encourage somebody to drop your coverage on the dwelling below the replacement cost. You got to have the right amount there. Don't shortchange yourself, because if you have a loss and you're underinsured, that just means it's coming out of your pocket. But if you're overinsured on things like your personal property, you might want to make some adjustments there. But a good thing to help you would be deductibles. Oftentimes policies are written with low deductibles. Have a quote at a higher deductible. Maybe you should be at $2,500 or maybe $5,000. I'm not trying to spend the money or tell you what to do, but if you have a quote that gets you at a higher deductible, it's going to bring your premium down potentially. So see if that's going to benefit you. And then shop around. There's over 100 carriers in the state of Oregon still issuing policies. It's still a competitive market. Yes, they're not all going to write you a quote based on every location, but it's still worth asking. If you're not getting quotes from standard carriers, you have two other options. Surplus lines. Those are the non-admitted carriers that are going to take on riskier options in the state of Oregon. And you can get those through your agent. Say, hey, I want a surplus lines quote. Again, not guaranteed that they're going to take on all risks. If you can get surplus lines, that's going to be your next best option. If that doesn't work, then you want to go to the Oregon Fair Plan. Oregon Fair Plan is the insurance of last resort. And again, not the best insurance because it's designed to give you essential basic coverage. But if you can get nothing else and you got a home that is financed and it needs to be insured and protected against fire and basic perils, Oregon Fair Plan will pretty much cover anything as long as it's physically sound and has a roof and there's not a wildfire burning around it, basically. So it's a decent option. Has to go through an agent, though, and consumers cannot go direct to Oregon Fair Plan. Like anything else, when you're shopping for an agent, like any service industry, you got to make sure that you trust the people, you get referrals, and that they're licensed. Do not work with an insurance agent that's not licensed, please. And you can verify that through DFR. And there's enough good agents out there that if you don't feel like you're getting a good vibe off somebody, go to the next one. I'm currently running down a time here, but the claims process is pretty cumbersome at times, and we've got some great resources. I hope nobody has to deal with a post-disaster claims issue. We have an awesome resource online for our post-disaster claims guide. The main thing is that you really want to go through and document every single step so that if something were to come up, you could go back to say, hey, I have the details of what I was told, and take your time. Go so slow. You don't feel rushed. You don't have to make quick snap decisions, and ask as many questions as you need to be clear on what's going on. All right. Because what often happens is when bad things happen, when a disaster happens, it brings out the worst in people, and they come knocking on your door and say, hey, I'm here to help you. And what they're really there to do is take your money. They represent, I'm here from the county, or I'm here from the city, and we're here to clean up your fire damage, or we're here to help you. And it's disaster scam 101. And people get taken advantage of all the time. So this is the one thing that we have seen a rash of following things like, unfortunately, like the Rowena fire that occurred in the Dalles earlier this year. And it just happens all the time. So again, it's a big problem, but something we unfortunately have to let people know of too often. Just to recap, our consumer advocate team, they're there to help answer questions. If you need to file a complaint, they'll walk you through that process. If you feel like you got scammed, they're there to help you with that as well. And they're there online or direct. And that's about it. A couple different resources. I gave you the FloodSmart one. If you want to check out anything about Cascadia earthquake, that's at crew.org. Our main website is dfr.oregon.gov. We're all over social media if you want to check that, and you'll see us on those. That's our contact information. Again, my name is Matt Ramage. And if you want to do the survey, that's great. If you don't, that's fine too. Good, bad, ugly, we'll take it all. And if you have any other questions, I went over a little bit, but I apologize. So, yeah. And I believe it's being it is being recorded, and yeah, I can get you copies of the slides. Sure.
Great. If you can get that to me, I can include it with the email that is sent out with their CE notification for the continuing education credit.
Sure, not a problem.
Awesome. Thank you. Great information.
My pleasure. My pleasure. Yeah. So you let me know if you need me to do something else, or you want me to switch it up. We'll talk about something else. And if there's an opportunity to do something in person, I'd be more than willing to do that as well. So,
all right.
Thank you much.
Thank you.
Of course. Yeah. Thanks, everyone.